Today's interview is brought to you by VanEck, a global leader in asset management since 1955. You'll be hearing more about VanEck's income-focused ETFs later on, but for now, let's get into today's interview. It's Monday, May 3rd. Fed Chair Jay Powell just got off the podium, and it's a historic day. We are joined by Jim Bianco of Bianco Research. Jim, so the Fed raised by 25 basis points as anticipated. Rates are now above 5% for the first time in 15 years. How historic of a day is this? And what are your broad takeaways?
It looks like the Fed wants to stop raising rates. We'll call it what the media has been terming this a hawkish pause. That right now the market is giving us about 15% or so chance that they're going to raise rates again at the June meeting, about an 85% chance that they're going to hold it. So it looks like for the moment, the rate hike cycle is coming to an end. Chairman Powell also talked about a couple of other things, that they've also got QT going at $95 billion a month. That is the reduction of the balance sheet. And so everybody understands what that is. The Fed owns $8 trillion worth of securities, about 100-ish plus billion mature every month. They buy back what matures less 95 billion, 60 billion less than treasuries and 35 billion less than mortgages. That is a restrictive act as well. And then he mentioned that, of course, the tightening of credit standards and what's been happening in the banking system is another restrictive act. So if you add it all up, it looks like the Fed is at least done for now. But he was asked a question by Mike McKee at Bloomberg whether or not there's a cut on the table. And he kind of dismissed that out of hand. There's going to be no cut unless the economic circumstances change. So for people watching this, call me when the stock market's down another 10 or 15%, because short of that, there's going to be no cut.
Right. And Jim, going into the meeting, how are you assessing the odds of another 25 basis point hike after this at the June meeting? And to what degree did your view change?
Yeah, I thought what we got was right where I was on this, that we were going to get the hawkish pause and that the market was going to hold from there. Going into the June meeting, I don't think he's going to get any reason to really raise rates again. The economic data shouldn't really be that's surprising. I suspect that you'll see about 180,000 jobs on payrolls on Friday. You'll see about 0.4 on the CPI number in the middle of May. That's not going to move the needle. He's going to hold on that data. Now, after the June meeting, I think he's going to run into a problem. I think that June is going to be the low of the year in inflation, and inflation is going to start drifting higher for the second half of the year. And I think in the second half of the year, we're going to see the cumulative effects of the banking crisis really start to bite. In other words, stagflation. We're going to see sticky inflation. We're going to see slowing growth, and he's going to have a dilemma on his hands. Which way is he going to pivot? Is he going to pivot towards the sticky inflation and talk about more rate hikes? Or is he going to pivot towards the slower growth and talk about potentially cutting rates? But for the June meeting, I think he's probably on hold. He's on hold for that meeting.
He's on hold for June. There was a question where Jay Powell said, based on the tightening of credit, based on quantitative tightening, we're getting close to there, and you can make a case that we're already there, referring to restrictive. So, Jim, how likely do you think it is that today was the last hike in this hiking cycle?
There's a very good chance it could be if outside effects come in, and I'm talking about the banking crisis. I guess we could pivot to that in a minute or so, because really, when you talk about the Fed, there's what's happening right now and what should be the appropriate policy right now. Okay. And even if you had a crystal ball and you knew that, doesn't matter, because what is about to happen next is really what's going to change the policy. And I think that all revolves around the banking system right now. And what is the resolution of what's going on with the banks? And that's going to be the real question, or the real thing that's going to drive his policy from here on forward. And I'll start to answer that. I happen to be worried that the banking system, the cumulative effects of what we've seen with the banks, is going to lead to a problem in the economy. And in that case, you might make the case that if the economy turns down enough, it'll drag down inflation and we might start seeing rate cuts. Let me say one last thing about rate cuts. Historically, when the Fed starts to cut rates, that is about the worst time to own risk assets. Why is that the worst time? Because, to put it bluntly, when does the Fed start cutting rates? When they're panicking. They're panicking that the economy is going down. When was the last time they started cutting rates? It was February. It was early March. It was March 2nd of 2020. Why did they cut rates on March 2nd of 2020 and start with 50 basis points? Because they were in full-fledged panic over the pandemic. When was the last time they started cutting rates before that? Was 2007. Why were they cutting rates in 2007? They were in full-fledged panic over what would be known as the Great Financial Crisis. And in 2001 was the last time before that they started cutting rates, January 3rd of 2001. Why did Greenspan start with a 50 basis point cut? Because he was in full-fledged panic as to what was going to happen with the economy. In each one of those cases, we were either in recession or we were about to go in recession and markets turned south. So be careful of the pivot. You're asking for the worst environment to own stocks. You're asking for everything to fall apart, and that's why the Fed cuts rates. I know people want to say, no, this pivot's going to be a declaration of victory that there's no inflation, and that's why they're going to cut rates. He, again, was asked that question, and he pretty much dismissed it. And I think he's right to dismiss it because there's not going to be any declaration of inflation being vanquished, and so therefore we can start lowering interest rates.
Right. So a pivot itself, actually cutting rates historically is not bullish, like 2006, 7. But the pricing in of a slowdown in cuts, that can be bullish, and that's what we've seen over the past 6 months. Jim, before I ask you about the banks, just for folks who didn't catch it, I'm just going to put on screen, and I know it's small to see. But this is the language shown by Nick Timmeros, who I'm interviewing tomorrow. Language that was in today's FOMC statement that wasn't in last March's meeting, and they did not have the line that the committee anticipates that some additional policy firming may be appropriate, and that was really sort of the dovish tilt that the market went to, and then 30 minutes after
the hawkish pause. That was the hawkish pause.
Right. So that's the hawkish pause. Yeah. Now, Jim, I've got some other charts that you've been putting on Twitter just about the banking system, and I know you had some questions for Powell. But yeah, Powell made a comment, and I'm going to paraphrase, but he said that broadly conditions in the banking sector have improved since March, and he said that today on Wednesday, May 3rd, 2 days after JP Morgan took over the assets of First Republic at 4 a.m. on Monday. What do you think about that statement that banking the conditions have improved in the banking sector since March?
Near the end of the presser, he also said that the deposit outflows have been stabilizing. And my first response was, are we talking about the United States banking system, or are we talking about a different banking system here? Because it isn't. I don't know what he's referring to. But let me back up, because I always start every discussion about the banking crisis or turmoil or whatever word we're going to use for it. What is it? What is happening to the banks? And I've been pushing back that everybody has been doing what they've been doing is they've been pulling out their 2008 playbook, and they've been forcing this situation into 2008. Stop doing that. This is not 2008. This is something different. 2008 was a solvency crisis. That was the banks invested in a bunch of stuff that lost them money. And then their assets went below their liabilities and they became insolvent. 2023 is a liquidity crisis. What is a liquidity crisis? Everybody's demanding their money back from the banks right away. And the bank doesn't have enough money or cash to meet every obligation to give people back their cash. It's a bank run. Now that can turn into a banking crisis. Oh, well, what about the duration mismatch? No one is running away from a bank because of a duration mismatch. Nobody knew there was a duration mismatch at Silicon Valley, that they decided that they were running away from that. And besides, it's all in instruments with no credit risk. They have a duration mismatch, an unrealized loss in treasuries. If they can hold them to maturity, they get paid back par. So, and besides, the last thing is, for all the people saying, well, they mismanaged their hedge. Yes, they did. They did mismanage their hedge. But remember, if a bank hedges everything perfectly, they make no money. They have to take a risk somewhere. They've been taking an interest rate risk. That has been the wrong risk to take. They've been losing money. But if there's this idea that they're supposed to have no risk, they have no profit either. That's where they make their profit. Now that I've defined this as a liquidity crisis, everybody wants their money back. What is the problem? The problem is 5% money market rates. The problem is 5 to 5.25% Treasury bill rates. The reason people are leaving banks is not out of fear, it's out of greed. They want yield. And that has been a bank walk. That's the phrase we've been using, bank walk as opposed to a bank run. And this accumulates week after week after week. And when we stress the banking system, who goes over the side first? The weakest players. I don't need a 118-page report by Michael Barr at the Fed to tell me that Silicon Valley Bank was a poorly run bank. I could see their 60-cent stock price and figure it out that they were a poorly run bank. I could see that for First Republic no longer trades to figure out that they're a poorly run bank. But why did all those banks go over this side? They've been stressed. What was the stress? Everybody wants their money out of the banks. Why do they want their money out of the banks? Because of greed. They want a 5% yield. They don't want a 0.5% yield, or in the case of JP Morgan, a 1 basis point yield. And that is what I'm afraid of. You should expect, when Jay Powell said the banking system is stabilizing, that is absolutely irrational behavior that people would say, oh, things are fine. Jack, move all your money back into Chase and get 1 basis point. If you have $250,000, you're fine with $25 of interest income a year, as opposed to spending 2 minutes on your phone to move it to a Chase money market fund. It'll give you $12,500 a year in interest income. That is irrational to say that the banking system has stabilized. People want income and they're moving towards higher yielding products. And after that should happen week in and week out. And when you get to the fourth quarter, all of that withdrawal is going to, I think, really hurt on credit standards and the economy. And what did the Fed do today? They made it worse by raising rates and further widening that spread. So I'll come back to the beginning. I don't know what banking system is better than it was in March and things have stabilized, but it certainly isn't the United States banking system. Maybe he's looking at some other country that I'm not familiar with.
Right. So, Jim, a key difference between this and 2008 is that there was a run on broker dealers who funded themselves in wholesale markets, whereas this is actual, mom and pop people with actual deposits, not sort of repo. But I think that point you also make about fear versus greed is so important. When people are pulling their money from Bear Stearns, excuse me, I say people, traders were pulling their money from Bear Stearns, pulling their money from Lehman Brothers. That was based on fear. Now it's based on, oh, hey, I can get 5% in this Treasury, 5% in this money market. The 1 basis point isn't cutting anymore. Oh, you're telling me I can get 170 basis points? Not good enough. And so it's a bank walk. When it goes into a bank run, there you are having a fear. But yeah, I think that's an important distinction to draw. Jim, tell us about.
Can I just interject on that? There is one level of fear out there, and that is in the bank stocks. And it comes back to what happened Sunday night, Monday morning. So I'm going to use a technical phrase for you, Jack. You can interpret it. Jamie Dimon pantsed the FDIC. He got such a good deal from the FDIC that it turned out to be a net negative. Why do I say that? Because they zeroed out all of the stockholders. They zeroed out all of the bondholders. That means they got nothing. They lost 100% of their money. The bank, First Republic, went into FDIC receivership. JP Morgan got to pick out all the assets that they wanted, got a loss guarantee, and then the FDIC held some of the other really bad stuff and took a $13 billion hit. So what is it that the message to the rest of the world was? PacWest, let me use PacWest as an example. The stock got hammered the last couple of days, down 40% or so through Monday and Tuesday combined, and it's at the low level. PacWest is headquartered in Beverly Hills. Now, maybe I'm just speculating for argument for illustrative purposes. Maybe the chairman of PacWest calls up another big bank that has some lineage with the West Coast, that would be Bank of America, and says, help me out here. Can you give me some deposits or something? It would be perfectly reasonable for them to say, you know what? You're going to go over the side and the FDIC is going to take you over. and they're going to zero out all the stockholders and bondholders. And why do they do that? So they could say it's not a bailout. And then I'll just pick your carcass out of the FDIC, take the assets I want, and leave everything else.
Mm-hmm.
So every bank investor is looking at the bank and going, is this a good value to buy the bank? Yeah, what's my downside? 100% loss, because there is a panic driven by falling stock prices that drives them into the FDIC, but no bank is going to step up before FDIC receivership to try and save them, and everybody loses everything. So yes, Jamie Dimon got a great deal, but the consequence of that great deal was every regional bank has been getting blistered since that deal, because it really was, do not step up and save anybody. Just pick them over once the FDIC takes them out. And so therefore, I think it was a bad deal that the FDIC did for the banking industry. It was a tremendous deal that Jamie Dimon did for JP Morgan.
Right. And I see what you're saying, that normally you'd want to acquire a competitor at a distressed sale. Oh, Bear Stearns, $2 a share in 2008. Ultimately, I think he got raised to $10 a share. But the ultimate deal is
right. Washington Mutual at $8 a share.
It's taken over the FDIC, and then you get to pick and choose those assets. So it's no incentive for a large bank to help bail out a smaller bank. And for bank stock investors, they're saying, hey, I owned that preferred stock of First Republic. I got burned. I got bageled. Like I did worse than Bear Stearns preferreds, which got made whole. I got totally destroyed. I'm not going to own any of this. And that's
right. And if you were to think about professional investors that own PacWest or Washington Mutual or Metropolitan Bank or Valley National, these are some of the I picked those four because those are the regional banks that were down more than 20% the day before we're recording. If they're having a meeting, what's the risk with, what's the valuation of the bank? Well, the banks are very cheap by historical valuation. What's our risk? 100% loss is what our risk is. Not that the stock just underperforms for a quarter or two. It is 100% loss. What's the possibility of that? Well, if the stock keeps going down and everybody panics, it becomes a vicious cycle to zero. Man, that's a possibility. That is a possibility with all of these. Well, what about Jamie Dimon stepping up and maybe buying these at distressed prices? I'm just repeating what you said. No, he'll wait until it goes into FDIC receivership and pick over their carcass. So yeah, this is the problem that we set up with the banking system, and it's not going to be any better. And I'll come back to what I said 2 minutes ago. I don't know what banking system Jay Powell's looking at to make him say this statement that things are getting better and stabilizing.
After last year's interest rate surge, income has made a comeback, and VanEck has the ETFs to help bring income to your portfolio. You can check out VanEck's wide range of income-focused ETFs using their income investing yield monitor, where you can search by yield, duration, and expense to find the ETF that fits your needs. With the yield monitor, you can effortlessly track monthly fixed income ETF category flows, yields, total returns, and more. To access VanEck's income investing yield monitor, go to vaneck.com/forward-guidance. Now the disclosures. Investing risk includes principal loss. Visit vaneck.com to read a prospectus before investing. VanEck ETFs are distributed by VanEck Securities Corporation, a wholly owned subsidiary of VanEck Associates Corporation. Thanks, and let's get back to the interview. Right, and that Jamie Dimon, CEO of JP Morgan Chase, which bought the assets from First Republic very early Monday morning. So Jim, there's the credit availability. So the Fed, it seems like Jay Powell is not paying attention to what you're paying attention to, the issues you just talked about. But he does seem, and the Fed does seem to understand that a credit tightening has already begun. And admittedly, they're tightening from very loose bubble, a credit bubble in 2021, 2022. But they are, especially at mid-sized regional banks, being tightened quite significantly. What today did Jay Powell say today that made you think that will affect their policy going forward, that they're taking into account that credit tightening, and how severe do you think that credit tightening will be?
I think the credit tightening will be severe, to answer the second question first, because as I said, as deposits leave the bank and as the bank continues to shrink, their ability to hand out loans is going to be in question. So you're going to run into a situation where a banker is going to say, good idea on your expansion of your business. I like the idea, but we just don't have the balance sheet to extend the loan. I'm very sorry. and that, as opposed to you're too risky, that would be the traditional type of lending standard crunch, because our standards have been raised. Our standards are being raised because our balance sheets are getting pulled back. So I think that this is going to be a problem that I don't think he's appreciating, because of his statement that, the deposit flows have stabilized. Again, Jay, explain to me why somebody won't pick up their phone and spend 30 seconds on their bank app to move their money to a higher yield, which means move it out of a bank. That this idea that things have stabilized is, you're saying people are irrational and they're going to stay irrational, and they're not going to chase higher yield. Yeah, they get a free toaster if you stay at the bank, but it better be a $12,000 toaster. But otherwise, it's not a good deal. Oh, yes, it's a pain in the ass to move your money back and forth between a money market fund and, to meet my mortgage payment, my car payment. But for 12 grand a year, I'll do it. For a couple $100 a year, I won't do it. And now that I've got a mobile banking app, this is the part that they don't understand. Mobile banking apps change it. There's 120 million people in the country that use a mobile banking app at least once a month. And guess what they use it for? To pay bills and to transfer money. Well, what are we talking about? Transferring money. They all know how to do this. Everybody knows how to pick up their phone and move their money from one account to another account. That's all we're talking about. Oh, when it comes time to pay my mortgage, I'll move the money and I'll pay my mortgage. Good. Now, instead of being 14 seconds to do it, it's 18 seconds to do it. And this is the problem, that they don't realize that this new technology has changed the behavior of deposits in banks. They do not operate the way they did pre-crisis. And the reason I say pre-crisis is we had mobile banking apps for a dozen years, but we had rates pinned at zero, so we didn't have this situation. Now that we've been raising rates so aggressively, this gap between deposit rates and bank and market rates is what's causing this issue.
So, Jim, at the end, Jay Powell said that he understood it. He said, he was asked, what are your learnings from these bank failures? And he said, mobile deposits, we were unaware that this could happen so quickly and so severely. I think he was referring to the Silicon Valley Bank, which, happened within a few hours, really. So he says that he's learning it, but you don't think that he's enough. You don't think enough.
No, I go back to the early part of the presser when Steve Leisman asked him the question about the February presentation. And Powell admitted, he was there and he remembered it and he thought it was a good presentation. And he thought it was informational only. And I'll just quote Steve Leisman. I mean, I tweeted about this earlier today, if you want to look at my Twitter feed. That's it right there. The example of financial risks. As Silicon Valley Bank, the 18th largest banking organization, has significant interest rate risk. Oh, that's just informational? That is not something that you, as the chairman of the Federal Reserve, sitting in a meeting, and they put that up on the screen and tell you the 18th largest bank has significant interest rate risk, that you think that maybe you should do something about that or inquire about that? No, but the guy that gave the presentation was from Kansas City, and it was the week after the Super Bowl. You probably asked him about Mahomes, and you were more interested in that than this. Jay, you blew it big time. They put it in front of you that this was a problem, and you didn't respond to it. And 3 weeks later, you went to Congress, March 7th and 8th, said you were going to raise rates. Rates shot up, and 48 hours later, the bank was out of business. Was it a poorly run bank? Yes. And were they on the edge? Yes. But you should have known that the policy of pushing rates higher was going to push them over the side. How do I know you should have known? You were freaking told that 3 weeks before they went out of business. But it was just an informational meeting, is all he was trying to say. I found that almost incredulous that he was trying to push that idea. I don't know what more we have to do to basically tell them that there is a problem, and they're not listening that there is a problem. When you raise rates this fast in a mobile banking world, and remember, banks, the loan books on banks and the securities on banks are yielding about 3%. That's what they're yielding. They can't raise rates to 4 or 5. They'll lose too much money. Now, you give them a year and a half or 2 years, those loans mature, those securities mature, and they can roll them out in higher yielding, and they can get their loan books and their securities books to 4.5 or something, and then they can raise their deposit rates in a year and a half. But people have been leaving every week this year banks for higher yields. And for him to be told straight up, not only are you causing this problem in the banking system, but Silicon Valley is the biggest problem. And just shrug his shoulders and go, "It's for informational purposes."
Jim, it was one
3 weeks
page.
later.
Jim, it was just one page.
It was one page. It was just one page. How many pages does it have to be for the chairman to act? I guess is really what the question is. So he might have been able to get away with the financials is big and complicated. Nobody told me, but we know now that they told him. We know that they told him there was this problem with interest rates. And I'm going to go, I'm repping Northwestern here with my hat on, but I wish I had my conspiracy, my tinfoil hat. But I will point out, and I pointed this out in a Twitter feed. I'm just pointing this out. I'm not accusing. Starting the week after that presentation, Silicon Valley Bank stock fell 10%. The average bank stock was down 2.5%. They didn't have a good week, down 2.5%, but SVB was down 10 the week after that meeting. Question: was that presentation leaked to short sellers and tech VCs? And they look and go, "Holy crap, on page 9, they're talking about significant financial risks to Silicon Valley. I got to get my money out of there. I got to short that stock." Did they leak that? If they did, and I don't know they did, I'm just asking the question. I'm just pointing out their stock fell apart the day after that presentation. If they did leak it, did they accelerate or contribute to the demise of Silicon Valley Bank? So I'm just pointing out the stock price started immediately going down the day after that presentation. And it's unusual for the Fed to basically point out a private sector firm. This firm has this problem.
Yeah, they never do that. They never say, "Oh, Ford Motors has this problem." They make auto prices are down, but very bird's eye view, 10,000 foot, very macro.
Right,
they never say
they put
Chipotle is raising prices. Yeah,
right. They put a specific bank and said it has financial risks, and starting the next day, stock starts falling apart. And I don't know. I'm just asking. That is unusual for that. If that document made it outside that boardroom to the right hands, short sellers, VCs, yeah, I'd look at that if I had a bunch of companies that I was funding that had money at Silicon Valley Bank, and I'd act on it. If I was a short seller that was trafficking in that kind of business, and I was told the Fed is now sitting there having meetings about Silicon Valley Bank's financial problems, I'd be willing to short that stock. And so, of course, no one's going to ask them. Of course, they still have to give me the answer to Raphael Bostic, not, with his personal trading account. They still have to give me the answer about Austin Goolsbee and about all of the shenanigans that went on with him getting the job at the Chicago Fed. But, we don't even hear about those investigations. There's probably
Jim,
not
what about the congresswoman who sold First Republic and bought JP Morgan?
Yes, I mean, well, at least that's not the Fed. That's Congress in and of itself. So you could go buy, just go along the Nancy or the Cruz ETFs, which are the Republican and the Democrat ETFs for at least for Congress. But that's my point, is that this all pins. So coming back to what I said a minute ago, yeah, we could talk about the state of inflation, we could talk about the economy, but it pins on what happens next. And what happens next is about what's happening in the banking system. If you take my view, which is the rational thing for people to do, pick up their phone, move their money, get a yield, then money comes out, money comes out, money comes out. Well-diversified banks, B of A, JP Morgan, they can handle these outflows. Not going to be a problem for them. But narrowly defined businesses, narrowly defined banks in localities or specific lines of business, which is a regional bank. A regional bank by its nature is more risky because it isn't this diversified global organization like JP Morgan. They lend to tech. They lend to Kansas City if you're the regional bank in Kansas City. So that when there is a problem like deposit outflows or commercial real estate loans, your bank is going to feel it first before a JP Morgan or a B of A feels it. And that's why the weakest of them go over the side first. In 2008, when we had a problem, it started off with BNP couldn't price their mortgage funds in August of 2007. IndyMac, Countrywide, these were the names. Well, they were all mismanaged. Remember, Angelo Mozilla was that crazy orange guy that no one understood, and that's why his bank went over the side. And then it was Freddie and Fannie that went over the side. Well, they were mismanaged too. And then it was eventually Lehman Brothers. well, they were mismanaged. It was AIG. They were mismanaged. And then eventually people said, how many times are we going to yell mismanaged before we start to realize there's a systemic problem here? And yes, the mismanaged die first in a systemic problem, but it is the mismanaged that are dying. And if that systemic problem is money is leaving, money is leaving, money is leaving, and now we've set up a precedent. No one step up and help a bank. Wait till they go in the FDIC receivership. Let the stockholders get zeroed out first. Then you can pick over and pick the assets and the liabilities you want, the assets and the deposits that you want out of FDIC receivership. Now you're going to have the people that are fearful are the equity holders. Is this bank going to get caught in a vicious cycle that's sending me to zero? The people that are greedy are the depositors. I'm leaving for a money market fund or a treasury bill at 5%. Right. And that will add up to a big problem by the fourth quarter.
Right. And Jim, anytime a CEO of a company or someone who's long the stock blames short sellers for a decline in the price, I'm very skeptical of them, because I think it's probably people who are long the stock just selling it for fundamental rational reasons. But with these banks, stocks,
Jack, you follow the markets.
It can accelerate deposit flow. It can be a self-fulfilling prophecy. And Western Alliance Bancorp said exactly that. And some of these troubled banks, deposits flooded out of them, but actually have gone back in from mid-March to mid-April. Jim, I just want to say that your theory about the Fed and Silicon Valley Bank, that's interesting, but as you say, we don't know that for sure. But I just want to underline for our audience here that what we do know for sure is that this report, where this page saying example of financial risk, Silicon Valley Bank, SVB, has significant interest rate risk. That was sent to Jay Powell mid-February, nearly a month before it fell. So I just want to say that's what we know for sure. There are some things we know for sure.
Right. And it's unusual. If you keep that up for a second, it is unusual for the Fed to basically name an organization like that. You're right. They always give the 30,000 view. There's significant interest rate risk in the banking system. Who? But they never really say it. But they named it directly. And what I'm arguing is, I don't know, but I'm saying, this thing leaks out starting February 15th, and people start in the financial community reading this, it's another technical term for it. Holy crap, there's a problem with Silicon Valley Bank. I got to get my money out of there, or I got to short the stock. And all I'm saying is, look at what its stock started doing February 15th, the day after. It started going straight down, is basically what happened after that. So yeah, this is a problem. And Jay just thought that this was kind of informational stuff. No big deal. I don't know how much more when it says the banking organization has significant interest rate risk, weaknesses in market management, and high RR exposures have resulted in, and then it shows the problems. Jay, how much more do they have to tell you that there's a problem before there's a problem there? It seems to me that this is pretty clear, that you flew in a guy from Kansas City and you had a DC staffer put together this to tell the entire board of the Fed that there is a problem here with Silicon Valley Bank, and you shrugged your shoulders and went out and said, we got to keep raising rates. And you made even more significant interest rate risk, and they failed 2 days after you gave your presentation that they're going to fail rates. Now, I know I'm harping on this thing about the stock price and stuff, and I don't know. But what I am trying to say is, this is what's going to turn the economy in the next 4 or 5 months. What is the resolution of all of this? Are people going to start to say, oh, I'd rather have the toaster than $12,000, move your money back from a money market fund to the bank? Are we going to continue to see that bleed? And again, will it hurt JP Morgan? No. Will it hurt B of A? No. But when you start getting down to the regional banks and they just continue to see money leave, and again, not out of fear, but I just want to yield, is why I want to leave the bank, because they can't really offer a yield. That can accumulate into a big problem. And the Fed is being told, but it's just informational stuff. There's nothing really for the Fed to do but to continue to raise rates. So I don't understand, like he said, what he was talking about that the banking system is resilient and that things are stabilizing.
Yeah, credit to Steve Leisman for really pushing Fed Chair Powell on that. So I think, Jim, people in the media, and I definitely include myself in this, have a bias to be slightly dramatic, negative bias, use words like banking crisis. But Fed Chair Powell obviously has a bias in the opposite direction. And yeah, he used the word resolution to talk about these bank failures, which can be the typical program, but it's not resolution as in, oh, this problem is resolved. It's resolution as in, like, it has been dissolved. The bank is no more.
Right,
Yeah.
exactly. And I know I'm getting myself animated here about this. I want to be clear about some other things. We don't need another bank failure. The only reason if we get another bank failure, it's going to be panic among the equity holders. That's what happened with First Republic last week. If stock went from $16 to $3 because of the bad earnings report, it was panic among the equity holders that pushed it over the side. But what I am worried about is this walk of people leaving. I'll give you the statistic that I've been using. A third of the workforce works for a company of less than 100 employees. Half the workforce works for a company of less than 500 employees. The bank that's best suited to service those companies is a smaller regional bank. If people keep leaving for the rational reason that they want to yield, and those banks are impaired at handing out loans, the entire economy has a problem, is what it has right there. Yeah, you're going to fix the inflation problem, but you're going to fix it by hurting the economy. And that's not the way that we want to do it. And that to me is, like I said, we could talk about where we are now. We could talk about what the payroll report's going to be on Friday. 180,000 is what the expectations are. I think we'll beat because we've done it for 12 in a row. And I'll just keep thinking we're going to beat until that changes. But nevertheless, it's going to be what is going to happen with these banks moving forward. And it really comes down to, do you want a 5% yield or do you want a 0.5% yield? And of course, everybody's going to say 5% yield. And that's why I think that this thing is not going to stop until we close that gap between deposit rates and market rate based rates. And that's the Fed cutting rates. They just raised rates again today. So we're not anywhere near them cutting rates.
Right. And it really is remarkable, given some of these regional bank business models, it really was remarkable that people thought that a 500 basis point hike over the course of a year would be good for these businesses because they acquire assets really quickly when interest rates are low, and they acquire them much more slowly when interest rates are high, because everyone wants to get a 3% mortgage and not a lot of people want to get a 7% mortgage, especially after they know that they could have gotten at 3% a year ago. But their deposit rates, what they're paying on their liabilities, is going up so much faster than their loan rates. And that's exactly what we're seeing. So net interest margins are going down. And you're absolutely right on. I mean, PacWest, for example, and I'm not fudding the stock by any means, but their lending has really fallen off a cliff, intentionally so, to preserve their capital. It's down 80%, 90% from first quarter of last year to this quarter. That's not systemic of the entire industry, but yeah, specific banks are certainly curbing their lending. But Jim, what would you say to the argument that it's not going to be systemic? Yes, these bank profitability are going to get crushed, but that doesn't mean that banks are going to continue to topple. Okay, just because a bank is only making 1% net interest margin and they're basically breaking even after they pay for employees and keeping the lights on, they're not making money. That doesn't mean that the bank will fail. And let alone a Lehman moment where it is truly systemic.
Well, I would agree with that, because I was actually arguing through last week that I didn't think we'd see another failure. Then of course we saw First Republic. And now what I'm worried about is the precedent that the FDIC sent is that, if Pacific West or one of these other troubled banks is on the phone with a larger bank asking for help, they've just told them not to help them. They've told them you'll get a better deal if you don't, not to not help them. You'll get a better deal if you let them fail and then buy them out of receivership. You'll get a better deal that way. And that is going to be a real problem for the banking system. So yeah, I don't expect to see any more bank failures. Maybe we'll get one or two. And if we do, it will be driven by panic among the stockholders, not panic among the depositors. Depositors will only panic when the stock goes down a lot, but it'll be the stock that drives the depositors. But this is important. Again, half the workforce works for small companies. These banks are the way that they get credit. These banks are the way that they get financial services. They are important for the economy. If these banks lose money, struggle with deposits, they're not handing out loans. And if they're not handing out loans and they're not providing services to these small and intermediate companies, then the economy is going to feel it. Earnings are going to feel it. We're going to see a broad-based slowdown in the economy. So no, this is not 08. We are not going to have a full-blown asset valuation-driven crisis. Now, we're going to have some problems with commercial real estate, but I tend to think The reason that I'm being demure about that is because everybody's talking about it. Because everybody's talking about it, it's priced in with whatever commercial real estate problem we are having. What people are not talking about is the bank walk, because they're all dust off the model of 08. Oh, banks are in trouble. There must be bad assets. Look for bad assets. You're looking at the left side of the balance sheet. I'm saying look at the right side of the balance sheet, the liabilities of the banks. That's where the deposits are. That's where your problem is. It's on the other side of the balance sheet. This is different from 08.
Right. And yeah, so, 2 years ago, you were one of the very few people who were talking about commercial real estate and offices and work from home. And it was a problem. So there was an edge there. But now, as you say, everyone is talking about it. So the risks might be
right. And the big thing we were talking about 2 years ago was, when I was talking about work from home, the retort was, everybody's going back to the office. You watch, they're going to go back. All right, we're more than 3 years past the pandemic right now. And if you look at the Castle office system data, which shows the percentage of office use, they're the security card company, the biggest one in the country, and they give out a statistic, what percentage of people in all the offices that they have security cards are going back to the office. It is stalled at around 50% nationally for the last year. And we're 3 years past the pandemic. We're not going back. The ship has already sailed. So now we understand that offices have a problem because we're not going back. But now that we understand it, it's somewhat in the price. And like it wasn't in the price of office real estate 2 years ago because we thought everybody was going to go back. It is in the price now. So yeah, is there a commercial real estate problem? Absolutely. Charlie Munger's 100% correct. But the stocks of a lot of these banks that are heavily levered to commercial real estate before the bank walk were getting crushed anyway because we have been pricing that in. It's always the thing you don't expect that is going to be the problem. And that's why I'd be surprised if first we talk forever about commercial real estate, then it becomes a problem. Usually isn't the thing we talk forever about that becomes the real problem because it's priced in.
Right. And Jim, just on the credit contraction points, do you think it's going to be severe enough that we will have a recession, maybe a bad recession? Or is it possible, I hate to use the term, it could be like a Goldilocks credit contraction that, the bank stopped lending. But guess what? It was all of this lending that caused the inflation in the first place. And there was a giant credit boom in 2022. I mean, it's objectively true if you look at bank credit expansion. Right. And so actually it will help the Fed in their quest to curb inflation. And also just note that I believe the last time we spoke, you've been a secular inflationist person and you thought, okay, things are slowing down, but the economy is still good. So I'm just curious if, I think it's the bank crisis has happened since we last spoke. Have your views changed because the facts changed?
Yeah. So taking the last part first, I am still a secular inflationist. I still think that the inflation rate will hit its low of the year in June. And the reason I think that is if you look at the base effect of inflation, you're dropping off huge numbers, 0.9%. In May of 22, the inflation rate for the month of May was 0.9. In June of 22, it was 1.2. 1.2 is one of the highest numbers ever recorded for a monthly number for the inflation rate. You drop those off and you replace them with a 0.4 or 0.3, which is what we've been getting lately. The 5% inflation rate goes to the low threes by June, just from what they refer to as the base effect.
Right.
What do you drop in July? You drop 0. That was the inflation rate for July, was 0. That's July 22's inflation rate was 0. Then you have a 10th. Then you have 2/10. Those are the numbers you drop in the second half of the year. Well, if we keep printing 3 and 4/10 like we have been, then the inflation rate bottoms in the low threes and it starts making its way back towards 4 and 4.5 by the end of the year, and it starts going back up. Now, that's unless you tell me, well, there's going to be a recession or $150 crude oil or $50 crude oil. Yeah. Then we'll have to adjust it for that. But without a recession or without any of that other stuff, the inflation rate's about to bottom. And then it's about to start to creep back higher. And that is going to be what the Fed is focused on.
Right. And Jim, sorry, let me explain that. So you're not so much making a call about what sort of actual inflation will be month over month, but you're just pointing out the fact that in June, the price of oil was at $120. So if the price of oil in this June of 2022, it was at $120. So the price of oil is $80 bucks. That is a huge deflationary force year over year. And the way that it's reported and most people think of inflation is, inflation's at 7%. They don't think month over month, it's at 0.5%, even though mathematically that's probably more accurate. So I just want to explain that basic point effect. So sorry, back to you and on the credit availability.
That's the base effect. So the idea about inflation, understand that the base effect is about over on inflation. And now in order to bring inflation down from here, you're either going to need a recession or you're going to need much lower oil prices, like $50, or you're going to need both. And usually you get both. When you get a recession, you also get very low oil prices as well. So you're going to have that inflation problem. On the other side about the lending problem, is this a good thing? Look, I just had organ in my house here a little while ago, and I like to kid around that, when everybody says, well, the credit crunch is going to do Orkin's problem. Look, I could go get myself a blowtorch and do Orkin's work of getting rid of the bugs in my house too. But that's not the way you want to get rid of the bugs in your house. That's not the way you want to get rid of inflation, by torching the economy. And that is why I worry about that. But let me also point out this. I talked about half the workforce is working for a company of less than 500 employees. The number of people that work for a company of more than 5,000 employees is exactly the same as it was in 1980. There's been no increase in employment of people of companies over 5,000. Now, why is that? Because the big multi-billion-dollar companies engage in productivity enhancements, robotics. I'll give you one example. General Motors makes a car today with 12% of the employees that they used in 1980. So 7 out of every 8 employee every factory worker that it took to make a car is gone. They've been replaced by a robot. And so they don't. So the point is, big companies, the Walmarts, the Amazons of the world, the federal government, they don't drive employment in the United States. Companies of less than 500 drive employment in the United States. So if you're going to have a broad-based credit slowdown among the small and regional banks, you are going to see the unemployment rate go up, and go up a lot, because that's where people get their jobs. They don't get their jobs from companies of 5,000 employees. They get their jobs from less than 500. Oh, well, that's going to do the Fed's job. That's my blowtorch example. Yes, like I said, I can set my house on fire there. I don't need Orkin anymore. I got rid of all the bugs. But that's not the way I want to get rid of all of the bugs. And so we have to be careful of what we're wishing for here. I don't want to see the small and regional banks struggle, because this is going to have a profound impact on the economy.
Jim, I've been in bank world. I haven't had enough time to focus the proper attention on the debt ceiling, which really is a looming issue.
Yes.
Several reporters today asked about the debt ceiling. Fed Chair Jay Powell, as expected, kind of dodged it, say that's not my job. That's Congress's job. And when asked, what do you think about the potential consequences of a debt ceiling not being extended, he said, "Oh, that's so horrible. I can't even think about that. We shouldn't even think about that." It's kind of it's a nightmare scenario. That was pretty funny.
Right.
Yeah. Can you just walk us through what's going on there? I think, did the Treasury issue some important news today and yesterday?
Yes. So let me back us up here a little bit about the debt ceiling. And I'd like to start off every conversation about the debt ceiling to remind people, because everybody says it's stupid. Why do we have it? Because the Constitution has a separation of powers, and the Constitution says that the Congress will approve all spending, and the president, the executive branch, will dispose of all spending. It is the job of the president to spend the money that Congress tells them to spend. So they have to have an oversight on things like the debt of the United States and spending in the United States. Now, prior to World War I, we didn't have a debt ceiling. Every time there was a bond that needed to be issued, the actual debenture went up to the Congress as a bill, and they voted on it, and the president signed it, and they'd issue the bond. But then we started Liberty bonds in World War I, and there was too many bonds that were coming every day. We couldn't do that, so we changed it to a debt ceiling. So we do need a separation of power. So if you said, do away with the debt ceiling, you can run up to the Supreme Court, and the Supreme Court say, nope. Congress has to have oversight on this stuff. You cannot allow the president to run unchecked when it comes to borrowing money. So we need it.
So
now we're abusing.
Doesn't Congress apportion it because they set the budget? Like if you say, oh, we're going to spend $1 trillion more than we bring in taxes and other things, so we're going to have $1 trillion deficit. Congress apportions that. The president signs it. the Treasury is then going to spend it. And then it has to go back to Congress to now have the ceiling approved of something that they already wanted, right?
Right. The other thing that I think I want to just say before I get into the nuts and bolts about this, that we need to have a debt ceiling. That's why it exists, because I think people have lost that idea of why it's there in the first place. The other thing we got to keep in mind too is that when Congress approves something, all of it is equally important. So I've heard people talk about, well, why don't we prioritize payments? Because remember, about half the money that we use to spend, the government gets about half of its money from taxes and gets the other half of its money from borrowing. So why doesn't it just use the half the money from taxes to pay interest rates? In other words, prioritize payments. I've been adamant about this. Prioritizing payments could be the end of the country because it will be abused in ways you cannot imagine. So you say, okay, we'll pay the debt ceiling, but we won't pay other things. Well, first of all, that's illegal. I think it's unconstitutional. You can run up to the Supreme Court and they'll say you can't do that. Second of all, the Treasury's already said they don't even have a computer system in place that they could actually say, we'll pay this bill and not that bill. They have to pay them as they get them. Third, why do I think it ends the country? Because the minute you're done with that, then a Democrat like Joe Biden could say, the old Republican in Congress, they approved a new aircraft carrier a couple of years ago. I've just prioritized the day payments and I don't have money to pay for that aircraft carrier. Or a Republican president could say, here's a bunch of Democrat priorities and I just prioritized some payments. I ran out of money to pay for the Democrat priorities. No, when Congress approves spending, it's all equally important and it all gets paid or none of it gets paid. And that should not change. So, and the reason I laid there, all these talk about mitigating this, the platinum coin, payment prioritization, invoking the 14th Amendment, none of them should be done. I think Jay Powell is what I'd like to say, what Jay Powell is saying is the proper response from the Fed is to sit there motionless and do absolutely nothing. This is 100% a political issue. We elected people to Congress and they decided to default on our debt. Do not undo that. Because the next thing is
we as the Fed can't save you. If the Congress decides not to pay the national debt and the US government becomes a defaulted entity, that's not my problem. I'm doing my job.
Right. Let me give you the example. If they did try to save us from it, then a couple of years from now, they could say, Jay Powell, the Republican Congress approved another aircraft carrier. Can you save us from that? Can you affect monetary policy to undo that aircraft carrier purchase? What a terrible situation we would be in. But that's what we'd be saying, is that we'd be saying there's some things that are more important than other things, and that's not his job to do. So I don't think he should do a damn thing about it. It's Congress's job to fix this. Now, what's happened the last couple of days? Janet Yellen came out and said that the X date, that's the new term, it's new in the last couple of weeks, that the date that we have to raise the debt ceiling or we get default is June 1st or thereabouts. Early June is where she said. That was earlier than a lot of people thought. We thought it was going to be at the end of July. Now, why the difference? Because June 15th is a quarterly tax payment by businesses. March 15th, June 15th, September 15th, December 15th, there's an inflow into the Treasury on that date. A lot of people thought we could make it to June 15th with the existing amount of money that the Treasury has in its general account. Then we'd get a bump up in it, and then we'd run all that down by end of July, early August. But what Yellen said is, no, we're not going to make it to June 15th. We're going to hit zero and run out of any money by early June. So there are some Treasury bills that are due in June 1st, June 6th, June 13th. These are maturity dates of Treasury bills. The fear is in the market that if you own a June 6th Treasury bill and that June 6th Treasury bill comes mature and you're supposed to get your principal back, but they don't have the money to give you the principal. The way they would have the money is they would issue another bill and they'd use that to pay you. Now, we've done that forever, but they don't have that ability anymore. You own a bill that matured and you don't get your money. If you're a money market fund, what is the fair value of that bill? You're supposed to mark your bills at fair value.
Less.
A lot of people have argued zero is what the fair value of that bill is.
Oh.
You don't want to own that because you risk breaking the buck as a money fund. If you own 1% of your money fund in a June 6th bill and that June 6th bill doesn't pay, the next day, do you price it? Do you say that your NAV on your $1 fixed money market fund is 99 cents? So We don't know. This has never happened. And so to make your life simple, just avoid that whole sector. So you see this enormous hump now in the Treasury bill yield curve. That's where it's showing up. Now, the reason I went through all that technical stuff is it's not showing up in the stock market. It's not showing up in the 2-year note. It's not showing up in the 10-year note. And the reason it's not showing up there is Washington and Wall Street have two very different views. I was watching some of the Sunday talk shows. I think I might have slipped, fell, hit my head, and I decided to turn on some Sunday talk shows this past Sunday. That's how much I like watching them. And the Washington wags would tell you that there's about a 33% chance that we're going to see a technical default this to go around. But if you look at the pricing in the market, it's more like a 4% chance.
Of credit default swaps?
Yeah, of credit default swaps. Yeah. It's about those are bullshit instruments anyway.
Jim, like I feel like people say, oh, owning gold is not patriotic. Bitcoin, because it's there's nothing less patriotic than owning a credit default swap on the U.S., in my opinion.
And by the way, I'll just say this real quick about the credit default swaps. It's a $12 billion market on a $23 trillion Treasury market. So it's 0.0001%. What is the definition? You'll love this, Jack. What is the definition of a default? There is a committee that meets, and it's called the Determinations Committee. Ooh. And they then declare an event of default. And they can make it and it clearly states in the ISDA agreements, it's whatever the committee decides is an event of default. 10 years ago, we had a restructuring in Greece, and they were in technical default of their bonds 10 years ago. It took them 2 months to determine whether or not they were in technical default because it was a highly charged political event. If we go to non-payment on that June 6th bill, oh, we're in default? No, we're only in default when the committee, the Determinations Committee, says that we're in default. And who's on that Determinations Committee? All the usual suspects, JP Morgan, B of A. And the reason I bring up those two is, who do you think is going to be the representative? It's going to be Jamie Dimon and Brian Moynihan. And
it's going to make all the hedge fund managers.
Right. Because the reason it's going to be them is because they will have had they will have had 5 calls from Janet Yellen that morning that if you declare the U.S. in default, you are setting the stage for the discussion of the 24 election. And if President Biden wins after you damaged him by calling this a default, he will remember. Don't kid yourself. They will. That's what happened with Greece 10 years ago as well. And by the way, you'll really love this. Guess who else is on the committee that gets to determine whether or not the U.S. is in default? Credit Suisse. They get the call. They get to make the call as to whether or not the U.S. is in default. So what I'm trying to jokingly say is this is a highly charged political event. Well, if you buy your credit default swaps and the U.S. stops payment, guess what? We'll be in day 37 of non-payment, and the committee will still be meeting and still be discussing and still be contemplating, and they won't call it because it's so political. And that's where I think that they're missing it. By the way, who buys credit default swaps? I found this to be very interesting in chatting around. It's largely been banks. And why have banks been buying it? And there's a very rational reason that they've been buying it. Since Silicon Valley, all of a sudden, all the regulators are running into the banks going, what's your duration exposure? What exposure do you have here or there? What are you doing about a potential default to protect yourself? Oh man, what am I supposed to do about potential default? I know, I signed a DISDA agreement. Yeah. I got the phone number of the dealer. I bought one credit default swap bond.
And it's super cheap.
Yeah, leave me alone. I bought one bond. I didn't buy enough to hedge the bank. I just bought one, so I've established a relationship. Now leave me alone. Regulator, leave me alone. I've got a plan in place, and these are very illiquid markets. So if enough banks buy one bond, the credit default goes through the moon, and then everybody tweets that chart out every 14 seconds on Twitter saying that the U.S. is going to default. Right. So be careful with that market. It isn't quite what you think it is.
Yes, and people seeing The Big Short about a little over halfway into the movie, there's a scene where the fundamentals are working out for people who bought credit default swaps, CDS, on all these subprime loans and CDOs, but they were getting screwed over by the banks. So that's, that happens. It's a dark market. And there's a time in mid-March when people were posting credit default swap rates on Deutsche Bank and saying, oh my God, the panic continues. And that was a legit trade, but Bloomberg later reported it was one trade. So it's not like, oh, Apple goes from 140 to 130 and it's a real market. It's just sometimes it's just one guy.
Yeah, exactly. And people in the credit markets will say, no, it's very straightforward. There's the rules and they follow the rules. Yes. If Bed Bath & Beyond, which 2 weeks ago files for bankruptcy, files Chapter 11, and then says that they're not going to make their debt payments, I don't need to put a lawyer on the determinations committee. I could put an intern on the determinations committee. Guess what? That is an event of default. It is not controversial. It's very simple. But when you get to nationally important banks like Deutsche Bank or countries like Greece or potentially the United States, these become highly politically charged things. So I just wanted to say, be careful with the credit default swap market. It isn't for US CDS. It isn't what you think it is. For non-politically charged corporations and stuff like that, the credit default swap of some struggling corporation like AMC or something like that, that's legit. But this is something completely different as well. So what will probably happen? What has always been the roadmap? May 9th, President Biden is finally going to sit down with Congress to start negotiating about the debt ceiling. They won't get this done by June 1st. They will agree to pass what's called a continuing resolution. This is what they always do. What is a continuing resolution? They'll raise the debt ceiling a little bit to say that now it's not. So we'll give the Treasury some borrowing authority so they can pay those June 6th bonds. But then the new debt ceiling X date is now June 30th. And then when we get to June 30th, they'll raise it again and it'll be July 15th. And they'll keep negotiating and negotiating until they find some face-saving way for everybody to walk away from this. And that's how this always works. It's always political theater and it's political brinksmanship. Because I agree, if we were to default, it would be catastrophic. And let me give you an argument about, you haven't heard, oh, we don't want to be a dead beater nation. Forget that. When JP Morgan bought First Republic for $10.6 billion, I'm going to be real simple here. Does that mean there's going to be a line of Brinks trucks with pallets of $100 bills to pay for this $10.6 billion acquisition? No. They're going to transfer a reserve from their bank to another bank and the FDIC to pay it. What is the reserve that they're going to transfer? It is a Treasury bill. It is a Treasury security because we treat Treasury securities as cash, as substitutes. They're the same thing as a dollar bill in your pocket. So if we default and those June 6th bills are, not getting paid, but the August bills, it's still, they don't have to get paid. It would be like I have some 20s in my pocket and I go to buy something in the store, but some of the serial numbers are worth 0 and other of the serial numbers are worth 20. What happens at the store? Every transaction takes 20 minutes. We got to look at the serial number. We got to look it up to see whether or not it's worth something. The whole system grinds to a halt. Everything stops. That's what would happen here. You would be introducing impure money into the money system. And it would be very, very detrimental to the entire payment system, to the plumbing system, because we are sending back, and banks, financial institutions, large corporations are sending money back and forth to each other, not pallets of $100 bills, Treasury bills. That's what they send back and forth to each other. And if you tell me, but some of those Treasury bills are worth 0 and other of those Treasury bills are worth 100 cents on the dollar, time out here. We got to redo this system to make sure we pull those bills out. I don't know if we have the capability to do that because the system was never designed for that in mind. So it would be very, very detrimental if we were to have a default of any kind.
Right. So just want to clarify. So you're right. The JP Morgan paid $10.6 billion, but it was to the FDIC. It was not the equity holders who were bought. They got nothing.
But they're not sending a line of Brinks trucks with hundreds.
There's no such thing as money.
10.6.
There's no such. Treasuries. There's except for gold.
They send them Treasury bills. Send them Treasury bills.
Yes.
But what if you sent them a June 6th Treasury bill that doesn't get paid? That's not worth anything, and that's when the problems start.
All right, Jim. So you know a lot more about this. I want to ask you than I do. You say it's worth 0. What I've heard is that the risk is not that you won't get paid. You will get paid eventually. The risk is that you will forego interest. So if you were going to get a small amount of yield on a bill that is going to mature on June 6th, you won't get the $100 back December, by which time you could have reinvested into securities that actually pay interest. So you're going to lose out on that, and that the sort of actual value will be something. Oh, it won't be $99.60. It will be $99.20. I think when you call things zero, I think I forget what you're saying. It's that the risk of money markets not being paid when they think they'll be paid is so severe that they don't want to touch it with, so they will not assign at a value of zero, but they just won't touch it. And that's why you're getting such weird kinks in the yield curve. Do I have that right?
Yes, you're right. So let me be clear on this. That zero argument for fair value is what is SEC Rule 827, which is basically that everybody that has to value their holdings every day, like a money market, has to use a fair value. Now, if you're a hedge fund or your pension fund and you don't have to value every day, and you see that there's panic, and you see a 5.5, which actually was yesterday, Treasury bill that matures on June 13th, well, I'll buy it. And if I don't get paid for a day or two, that's fine, because I don't have to value my securities every day. If it's a couple of day delay to get paid, I'm fine with that. So they'll buy it, but it's the ones that have to get mark to market every day to a fair value. Now the question becomes, you're right, what is the fair value? There has been some argument that the fair value for those that like money funds, that it's zero on non-payment, or it's just the loss of interest. It's 99.91 the first day you miss, 99.8 the second day you miss, and so on and so forth. No one knows. But let me give you a hypothetical example. The largest mutual fund in the United States is the Fidelity Cash Reserve Fund. It is the biggest money market fund. It has $216 billion of assets. By the way, 102 of it is in reverse repo at the Fed, 47%. And that's perfectly fine for them to do that. That fund generates $1.1 billion of fees to Fidelity. It is the most profitable mutual fund in the world. Why do you, and I'm going to use some technical language here, why do you want to fuck with that? By saying, let's own some June 6th bills and argue about what their payment valuation should be on non-payment, and potentially risk printing 99.9 on the NAV. Just avoid the whole thing altogether. I like the $1 billion this fund is bringing in. Don't screw with this.
Yeah.
Get away from that sector. That's what I say it that way because that's the way people are looking at it. I don't want to get involved in a protracted fight about what is the proper value, 99.9 or zero. I'll just avoid the whole thing, keep collecting my fees, keep watching the inflows from the bank walk. Thank you very much. That's why you see that big kink in the yield curve. It's not been settled as to what that value should be, because this has never happened. And this gets into the definition of what is fair value on a Treasury bill that does not get paid at maturity. Is it zero, or is it just the mere loss of opportunity? So, you could argue it's a loss of opportunity, and then the SEC could come in and say, no, it's zero. And now we could go to court and argue it for 2 years. Is that worth your time? Is that worth your effort? No, just avoid the whole thing.
Yeah. People who own it, to people who own it and who can own it, it's definitely not zero, but the rules can say it's zero, and funds can act in a certain way that they would value it
right.
as if it were zero. So Jim, what does the yield curve look like now? I know I did about 2-3 weeks ago, I did an interview with Jeff Snyder at the time, probably the bottom in the yield for the 1-month Treasury bill, which was super, super low. But I know that that's gone back up now. And I wonder if actually the fact that the U.S. is, the debt ceiling, the X date is now June 1st, that means that those 1-month securities are no longer money good, right?
Well, at the 1-month maturity level, yes. But the ones that mature, remember, every week, the Treasury issues Treasury bills, sometimes more than one a week. There's a 6-month and a 3-month that they issue. There's a 1-month that they issue. So if you look at all the Treasury bills, all Treasury bills are less than 1 year. There's like 60 of them out there. There's like a couple every week that mature. So if you look at the ones that mature before May 30th, their yield is down around 450, 440, at least the last time I checked earlier today. And if you look at the ones that mature around June 13th, their yield is up around 520, 530, 540, up almost 100 basis points higher. Now, I've argued the reason that you've got that very low level at the very short end of the yield curve is the average maturity of a money market fund, the securities that a money market fund owns, the average maturity is about 20 days. That's what they're buying. All the money keeps coming into these money funds and they keep buying at the 20-day average maturity. They've been the ones that have been keeping the front end of that depressed. It's the bank walk that's been keeping it suppressed. The higher yields around mid-June, because that's right after the X date, those are because of the debt ceiling. So there's two things happening at once, but that big, huge curve is still there as well. And as a matter of fact, if you look at there is a Treasury bill that actually matures on June 1st. Its yield is up over 120 basis points in the last 3 days. I don't think I've ever seen a yield do that. And that's just the money funds that owned it don't want the hassle that we just talked about. Just sell it and move. Just sell it and buy something in August. It's just so much easier. Or buy something, and that's what they're largely doing, is they're just avoiding that sector.
So yeah, Jim, I mean, how do you think this plays out? I know in 2011, many people were worried, but eventually, Congress got its act together, it raised the debt ceiling, everything was fine. I don't know if Treasury yields went up, they went down, probably both, but at the end of the day, everything was fine. Why do you think this might be different? And then also, what's going to happen if this might be different? And then also, if the Treasury, the debt ceiling does get raised and the Treasury issues, $1 trillion worth of paper, that's not necessarily great for liquidity.
Right. So I'm going to watch President Biden because he's going to be the swing factor in all of this. I believe, from what I've seen, Speaker McCarthy wants to come up with some kind of a deal, but President Biden, up until Monday, refused to even talk to him. There's nothing to talk about. Just pass they called it a clean debt ceiling bill. It's too dangerous. You have to pass a clean debt ceiling bill. Now, let's go back to 2011. How did Obama handle it with John Boehner, who was the Speaker of the House at that point? They talked and they talked and they talked and they talked and they talked. And they were making progress, and then they weren't making progress. And then finally, Obama kind of came out and said, God, I've tried. I really, really tried to do with it, but this guy's being completely unreasonable. And then we took it to the brink, and it looked like the Republicans were going to get completely blamed for it. And then we found a deal with what was called sequestration, if you remember that word from back 10 years ago. And then a crisis averted. My concern now is if President Biden looks too intransigent, I'm not going to talk. I'm going to be unreasonable. I'm just going to call Speaker McCarthy names, but I'm not really going to negotiate with him on finding a way out of this. He might set himself up to take some of the blame. And the Republicans will always get some of the blame. And my fear is, if it's 100% the Republicans' fault, they won't default. But if it's 60% the Republicans' fault and 40% Biden's fault, they might go for it. And so Biden needs to, I think, do the Obama thing. Talk, make some progress. We'll give a little bit here and there. And then if he wants to come out at the last minute and go, man, these guys are unreasonable. I really, really tried. But then at least you look like you tried. But if all you do is give them the finger for a month and not even pick up the phone, it looks like you're the problem. It doesn't look like so much that they're the problem. So watch Biden as far as where we go. Now, we get a deal. And that deal comes, you're right. That is another big drain on reserves because remember, the Treasury is going to issue a ton of securities. Where does that, they sell Treasury bills. That money goes where? It goes into the Treasury general account. The Treasury actually has, think of it this way. The Treasury has a checking account and their bank is the Fed. Yep. And it's at the Fed. But remember, the money in the Treasury general account is not considered money in the financial system. It's separate from money in the financial system. So as they sell hundreds of billions of dollars of bonds and they raise hundreds of billions of dollars that gets piled into the Treasury's general account, that is effectively taking money out of the financial system. That is another drag, like quantitative tightening is, like the deposit walk is. The deposit walk is a drag on the financial system because it's money coming out of banks and it's going to non-banks, money market funds, and it's going to fintechs that, in reverse repo. Guess what? None of those are in M2, which is why M2 is falling. Yeah. The reason M2 is falling is not because money is being destroyed. It's because it's being moved to non-M2 things, which is outside of that. Well, money in the Treasury general account is also a non-M2 thing too. So you'd be sucking more money out of it. So the reserves in the banking system would get tighter. That medium-sized bank that's looking at financing a $75 million apartment building in Kansas City that might employ a few hundred construction workers is that much closer to saying, good idea on the apartment building, love the location, love what you want to do with it. I think you're a good credit, but I just don't have the balance sheet to hand out the loan. I'm sorry. They were that much closer to saying that if we start dragging that money out of the system. So yeah, there is going to be a back end of this, and that is money getting sucked into the Treasury's general account through the issuance of bills. Think of that as money leaving the financial system. It still exists,
Right.
but it's not part of the financial system. It's part of the government's owners, and the government is not part of the financial system for these purposes.
Right. And if a lot of the money to buy bills comes out of the reverse repo facility, the liquidity drain will be less severe. If not, it could be quite severe. All right. So Jim, given moving back to the Federal Reserve and the banking system, given your views on the health of the banking system, and it's, sounds like you think that there will be more issues. I mean, what would you do if you were Jay Powell? He's already raised rates to 5.25%, highest in 15 years. To cut them immediately would look kind of weak. Not that, it's all about optics. Quantitative tightening is still running. You've got the bank term funding program as well as the discount window, usage of which has been slowly edging down. I mean, what would you do, Jim Bianco, chair of the Fed?
Well, the chair of the Fed has two jobs, right? He has monetary policy, which is the fun stuff that they like to talk about all the time. And he's also the head supervisor. He's also the head regulator for the banking system. I would probably, in Fed speak, they call that macroprudential. I'd probably look more towards macroprudential rules. I would probably look towards when everybody shows up at the bank and says, give me my money back, and it squeezes the bank, what option does the bank have? They take their assets, securities that they own, and they pledge them to the Fed to get a loan for money. And that's how they meet all of those withdrawals. I'd loosen some of those rules. Now, they've done a little bit of that right now to at least make banks be able to, come to the window. The FHLB, the Federal Home Loan Bank, it does something similar, but it's usually with residential mortgage type securities as well too. But the big problem we have is if you own securities, you can pledge them to get a loan for outflows. But 73% of the balance sheet of a small bank is actual loans on the books. You can't pledge a loan to the Fed or the FHLB to get cash to meet withdrawals. You can convert those, you can maybe sell those on Wall Street so they can package them into a loan as well. I would encourage the small banks to start moving some loans off of their books. Now, that's easy to say. The problem is I did the loan months ago and it has a 3% yield. We're in a 6% world. So if I sell the loan, it's worth 94 cents.
And now everyone wants to sell it now. The time to sell it would have been before the bank crisis.
Right. But I'd also have to realize a loss if I sell the loan now. So I understand that that's easy. In other words, there's no really good option. And I would be very, very focused on the flight of deposits and the response by the small banks on their lending standards, because I think you could see a dramatic slowdown in the economy. Like I said, you can have a banking crisis with no more failures of banks. It's just that everybody acts rationally. I like 5% money market funds. I don't like 0.5% savings accounts with banks. And there's your problem. And why wasn't that a problem in the 90s? Because you didn't have 120 million mobile apps. That's why it's a problem now. And so that's where I think we need to focus. That's the best way you could do it. Look, you asked me what I would do today. All the Fed has today is trade-offs. They don't have, here's the policy that fixes everything. The policy that would have made this work would have been when they raised rates in March of 22 for the first time, the inflation rate was 7%. They waited till 7% until they until they started raising rates. If they started raising rates at 3.5 or 4 a year earlier, went 25, waited a meeting, went 25, waited a meeting, 25, waited a meeting, and took your time to get the 5%, a lot of those mortgages and a lot of those loans and securities would have rolled over into higher yields, and the banks wouldn't have been able to follow with their deposit rates higher. Instead of giving us 75 for 4 consecutive meetings, you raced way ahead of what the banks could do, and this is what you've got. So the mistake was made 2 years ago by keeping rates zero for way, way too long. All the Fed has is trade-offs.
Mhm.
They don't have a policy. Do this and everything will be okay.
Right.
So that ship sailed.
The ship sailed. Yeah, it's already too late. Jim, you've been very generous with your time. I do have 2 more questions for you, but in the meantime, people should check you out on Twitter at Bianco Research. I think they should check your work out at Bianco Research. My first question, Jim, is just to sort of sum up the Fed statement today, and Powell reiterated it. Said that, quote, the U.S. banking system is sound and resilient. How do you feel about this statement? And if I could do sort of like a poll-like question, strongly agree, neutral, disagree, or strongly disagree?
I'm going to give you neutral. And the reason I'm going to give you neutral is I want to put a nuance on it.
Okay.
The big 4 banks are strongly resilient. And that's because they're large, diversified businesses. But the narrowly focused regional and small banks have always been a little bit more vulnerable, and they're more vulnerable to this bank walk type of thing. So that is the problem. Now, I will point out that, what is a bank? And I actually tweeted this out earlier today too. A lot of people listening to us think a bank is a warehouse where we put our money, right? Instead of putting it in a shoebox under my bed, which could catch fire or be lost or stolen, I put it in the bank and they give me some interest. And Felix Solomon of Reuters said, well, why do we even have 4,000 banks? Why do we have 4? Well, if all you think of a bank as a warehouse to stuff your money into, and that's a legitimate use of a bank, then he's correct. We only need 4 banks. But if the purpose of a bank is intermediary, to basically give that apartment builder a loan in Kansas City to build that apartment, then we do need 4,000 banks. And so, yes, the warehouses that we keep our money in, they're safe, they're strong and resilient. But the rest of them, by the nature of, look, they hand out loans in Kansas City. They don't have global multi-line businesses that one business is good and the other business isn't good and it all balances off. If handing out loans to real estate developers in Kansas City is a struggling business, and it is, then the bank is struggling. I'm sorry, that's just the way it is. And we all understand that because that's the nature of being a small and regional bank. And we need them because if the option is, instead of getting that loan from a small regional bank in Kansas City, you have to call a branch of Chase or B of A in Chicago and ask for a banker there to give you the loan. Good luck trying to get that loan. Good luck trying to get them to understand your business, let alone get that loan. So what you have is the large banks. Who are the bankers in the large banks? The B of A's, JP Morgan's. They're wealth managers. They're there to help you invest your money. Who are the bankers in small and medium banks? They're lenders. They're there to help you lend money. So yes, the large banks are safe. The small and medium banks are generally safe. I'm not worried about that depositors are going to lose money, but what I am worried about is their ability to keep lending could be severely restricted in the coming months. So that's why I give you neutral. It's not as so much as that the banking system is sound and resilient. It's a little more nuanced than that.
I appreciate that nuance, Jim. Final question for you is Nick Timros, who asked a question of Jay Powell today, chief economics correspondent at the Wall Street Journal. He's been asking interesting questions where sometimes it's kind of reductio ad absurdum, just like assuming the case. He's kind of assumes a super dovish case of like, why not just not hike at all? And it's kind of an interesting way to get about it, generate a good, interesting answer. So I'm interviewing Nick tomorrow. Do you have any questions that might be good for me to ask Nick?
Yeah, I actually thought his question was actually pretty good. I mean, he asked the question that, we're getting close to neutral. We need to assess what it meant that all the rate hikes that we've done so far. So why you keep raising rates if you need to assess what you've done? Stop and assess it. I mean, I'm not saying that that's what they should do. You told me you need to assess it. I think most normal people, not Federal Reserve officials, would say, I need to assess something. That means stop doing it and figure out what has happened for you. Don't keep doing it and then assess it along the way. So I thought his question was very good. I would, my bias is to ask him more about the banks and how the Fed is viewing the banking system, and I thought the most interesting question was Leisman's question. And I thought that his answer was really weak. We've put it up twice. I don't know what more the Fed needs to be told that there's a problem here. Oh, it's just informational purposes.
Jim, it's just one page.
Yeah, it's just one page. It's just one page. I don't know what more they need. So I would maybe lean a little bit more on them there. And this is my bias because, like I said, you could tell me where inflation is now. We went through that with the base effect, or where GDP is going to be, or where the employment is going to be. But you tell me what the cumulative effect of this bank walk is going to be in 5 months, and I'll tell you where the economy is going to be at the end of the year. So that's kind of where I'd focus on it. But I thought he had a good question. If you're going to assess something, stop doing it and assess it. So, but they kept doing it and they're going to assess it. So it's just more confusion from the Fed.
Right. And I think the great part of Nick's question was it kind of softened Powell up, so that Nick's follow-up question was about how long is it going to take to see disinflationary pressure, longer than 6 weeks. And by the way, 6 weeks is when the June meeting is. And Powell actually said yes. So if we do get another hike in June, which the market it's not the base case of the market, doesn't sound like it's your base case, not my base case, but that might have been a little glimmer there that he's keeping the door open.
Keep in mind too, I will say this, that the market is not pricing in a rate hike for June, but 3 or 4 weeks ago, the market was not pricing a rate hike for May.
Yeah.
And then we got an avalanche of Fed speakers saying, we're going to raise, and then it priced it in. As I said, there's a dance that the market does. The market prices an outcome, the Fed suggests an outcome, and they kind of come to an agreement. Sometimes the market forces its will on the Fed. Sometimes the Fed forces its will on the market. The May meeting was the Fed forcing its will on the market. The market had not priced in a rate hike, and the Fed kind of forced its will to price it. So they can always start coming out in 2 weeks or so and start trying to impose their will for a June rate hike. So just because it's not priced in now doesn't mean it's completely off the table.
That is an excellent point. Jim, thanks so much for coming on, sharing your insights. We'll leave it there. Thank you everyone for watching. Forward Guidance, the program you just enjoyed, hopefully, can be viewed on YouTube at Blockworks Macro or heard as a podcast on Apple Podcast and Spotify. Episodes are typically released on Apple and Spotify a few hours before they air on YouTube. Please leave a review on Apple Podcast if you feel so inclined. Also, you can get 10% off to Permissionless 2023 and Blockworks Research using code GUIDANCE10. Thanks again, and be well.